Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. Regular viewers will be in no doubt that we are moving into a new investment age, due in part to the success of the vaccine rollout. But with the UK and the US being the poster boys of global vaccination, are investors ignoring the opportunity within European equities at their peril? Well, today I will be discussing this and other topics with Rob Burnett, manager of the Lightman European Fund, whose performance since launch in 2019 has been piquing investors' interests. But first, before we get into the chat, if you're enjoying the content, it would be wonderful if you could subscribe. This really does assist us in delivering our financial planning and investment manager content to a wider audience, and you would genuinely be helping us all on our channel. So onto the content. Many thanks once again for your time today, Rob. With the reopening of global economies, we are seeing a discernible rotation from the tech-based growth stock success stories, that's a great bit of alliteration, of 2020, and into more cyclical areas of the market. Can Europe be a net beneficiary of this?
Yes, I think, Andrew, I think definitely it can. And in a way, the lockdown sort of provided this great opportunity, I think a multi-year opportunity where, as we all recall, investors were panic buying those companies that were perceived to be able to weather the lockdown, those defensive techie growth companies.
Yeah.
And there was panic selling of the more cyclical components of the market. And it opened up this incredible polarization in valuation, almost a once in a generation gap in valuation between those two areas of the market. And, that led to obviously a very compelling starting point for those cyclical ideas. And for Europe itself, Europe happens to be a little bit more exposed to that sort of cyclical economy versus the US. The US, as you well know, is incredibly tech heavy. If you add in the FANGs, to the tech sector, it's nearly 37% of the benchmark that incorporates tech, whilst in Europe, it's less than 10% tech heavy. And those sort of industrials, materials, financials, autos, all of those areas that are really well poised to accelerate away from here, from an earnings point of view, are very well represented in Europe, cheap share prices, strong balance sheets, great earnings growth. And so I think Europe is actually in a good position. And, the great irony is the lockdown has provided this opportunity, and it's it as a multi-year opportunity. And maybe the last quick thing I mention is from a cycle point of view, we do feel we're quite early in the cycle for these businesses. So I won't sort of dwell on it in too detailed fashion, but Europe actually slipped into a recession in the summer of 2018 in its industrial economy, in those areas that are facing those interesting cyclical stocks. So we've got a lot of runway to recover. We've got low valuations, we've got a lot of earnings growth. So yeah, I think Europe is in a good spot, definitely.
It sounds really exciting for investors. Moving on and looking at obviously like more of a global macro theme. How have the fortunes of European companies been affected by COVID? And do you see this as perhaps a reason why the region has been overlooked?
Yeah, I think, we all know that Europe's vaccine rollout has been a bit slower. And the lockdown has been a little bit more long lasting. And so, it's the nature of the European Union that it's very methodical and sort of, steady in its approach. And so the process of approving vaccines was a bit slower. The process of procuring them was a little bit slower. And so that has led for the, UK and the US to have a little bit of an edge in terms of time. But Europe is basically very fast catching up. And as is typical of Europe, once a decision is made, logistics and all of those things, Europe is incredibly capable, in sorting and delivering. So this quarter, Q2 2021, Europe is set to deploy 360 million vaccines, a monumental amount. And, it means that over half of the adult population will be vaccinated by mid-July.
Mm-hmm.
And so Europe will basically be where the UK is now. And the sort of reopening story that's been quite helpful for UK and US equities comes through into Europe this summer. And so I think it is an opportunity, this idea that, Europe has been a little bit overlooked. Some perception has been that they could have done the vaccines a little bit better, but it's just a 2.5 month delay versus the UK. And so we have that sort of reopening story coming through this summer and into Q3 and Q4. And so European economic momentum will accelerate quite sharply over the summer. That will be good for earnings. That should be good for share prices of the kind of companies we're interested in. And I actually think, you've also got taxes going up in the US likely later this year. And so I think there's, capital gains could go up in the US, income tax could go up. There's likely a digital sort of consumer digital tax that might come through as well. And all of those things might mean we might see some money leave the US equity market, given post-tax returns will be going down with taxes going up. So I think quite a lot of money might move into Europe, through this summer and into the tail end of this year, which is coinciding with hopefully an acceleration in economic momentum with the vaccine rollout being more successful. So yeah, I think it's an opportunity to look at Europe, and this fact that Europe has been a bit overlooked. It's just because of this 2 to 3 month delay over the rollout, and that we're going to be there by July, August. So it does look like a nice time to be allocating to European equities.
It certainly does. Moving on to your fund specifically, what should potential investors understand about your particular approach, and where are you currently positioned?
Yeah. So we are a value-based investor, and really why we invest is to get something back and get something in return, and get something in return quickly, primarily in free cash flow terms. So what we're really interested in is finding companies that generate a lot of free cash flow as a proportion of their market value, that have strong balance sheets, that have growing earnings, and so we can be rewarded, if you like, quickly for our investment. And the other side of the coin is the sort of the ultra kind of growth style, looking at expensive securities, is where you're kind of speculating about where a company might be 10, 20 years hence, and with very high valuations typically. And that's really what we're not particularly interested in. And so to give you an example of the sort of the two poles that I think are relevant on a global market basis today, you could say VW on the one side, company we like, and let's say Tesla on the other. But Tesla doesn't sell bad products, but Tesla, VW sells 20 times more cars than Tesla on a trailing 12-month basis, and it's 20% of the price, right?
Yeah.
So per unit sold, or per car, Tesla's 100 times the price.
Yeah.
So every car Tesla sales is currently valued at 1.4 million in market cap terms.
Yeah.
Car VW sales is worth $14,000 in market cap terms, and so 100 times multiple. And so for us, our thing is, our discipline, our focus is feet on the ground, focus on strong free cash flow today. VW is the kind of company we like. Tesla is the kind of company that we would be very nervous about owning at this valuation. And similarly, there are many other companies that in the industrial sector, even in the banking sector, that we really think are rehabilitating nicely. They're all associated with low valuations, high earnings growth, decent dividends, preferably share buybacks. There's a lot of them in Europe, and so it's an exciting time in European equities from our point of view.
Absolutely, I wholeheartedly agree. I think as you've outlined, the opportunities are there, multifaceted opportunities. It feels like the stars are aligning, but moreover, the opportunity set in Europe is potentially huge, and for careful stock picking and understanding what you're actually buying. I think repeating the word, the opportunity is there for investors to look at Europe with with great fondness, and investing with someone like yourself can hopefully generate those excess returns that everyone's really demanding at this moment in time. Rob, once again, it's an absolute pleasure to sit and talk. We've spoken on numerous occasions recently. It's been an absolute pleasure. You take care, and I'm sure we'll speak soon.
Thanks, Andrew. Cheers.